to the Loan Officer Training Series with the Mortgage Calculator. Hope everyone's having a great evening. We're going to wait a few minutes here to get started to go live on all the different platforms. We are streaming live on YouTube, Facebook, and LinkedIn, so give us just a moment to go live on all the different platforms. In the meantime, feel free to drop a comment. We put it up on the screen, but I see there were already some people dropping comments there, so appreciate you tuning in, dropping comments there. Oscar, Owen, Raul, Susan, Julio, Harriet, Natasha, Leonardo, Adrian. Appreciate the comments there. As everybody tunes in, feel free to drop a comment there. Looks like Leonardo saying, who's going to Miami in December? Everybody. Real Estate Weekend Miami, December 1st through the 3rd. Visit realestateweekendmiami.com for info. The whole Mortgage Calculator team will be down there. We hope to see everyone in Miami in December. All right. Thank you for the comment there, Jason, Key. Appreciate that. We'll get started here in just a moment. All right. Looks like we are live on all the different platforms, so we are good to go. Let's take the chat off the screen here, and then we can go ahead and get started. So welcome, everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. What we do every Tuesday and Wednesday evening at 7 p.m. Eastern is this loan officer training series. Each week, we pick a different topic, and this week's topic is going to be working with first-time home buyers. So our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, no years off, 28 years straight as a loan officer and a realtor, is going to give us a breakdown here of working with first-time home buyers. As we go through the presentation, feel free to drop any questions you have in the chat there. We're more than happy to answer any questions that anyone has. With that being said, Jose, let's talk about working with first-time home buyers.
All right. Good evening, everybody. Thank you for joining us for tonight's training. Great to be with you. So, first-time home buyers, good niche to be working, especially since first-time home buyer programs have a little bit lower rates than our traditional conventional products right now. So we're looking for every little edge that we can get to compete. A lot of times we're working with first-time home buyers and we don't even realize that there are options like the ones that I'm going to go over tonight that do give us preferred rates and lower mortgage insurance, which are options available. Now remember, we are consultants, right? We're not just high pressure salespeople trying to just push that deal down their throat, right? We want to consult, we want to empower them with information, we want to empower them with knowledge so that our clients can make educated decisions, right? So what do we mean when we're talking about first-time home buyers, and what are we talking about? Well, let me get right into it here. So what is a first-time home buyer? So when you're doing your application, when you're answering those declarations, the borrower's answering the declarations, it asks them, have you owned the property in the last 3 years? That's to make a determination if they are a first-time home buyer, especially if you are doing DU for your deal. So first-time home buyer, a buyer who has not owned the property in the last 3 years. Now that doesn't mean that they've never owned a home, because sometimes there's the misconception that some people think that a first-time home buyer is a borrower who's never owned a home. No, just who hasn't owned a home in the last 3 years. Now, these first-time home buyer options that we're going to be discussing are for primary residences only. The mission here of the first-time home buyer programs is to help families of all income ranges. Now, I stress all income ranges because we do have multiple options. Some I'm going to touch on briefly because we don't really offer them so often here at the Mortgage Calculator, and others I'm going to offer it in much more detail. But to stress, they've been created to help families of all income ranges achieve the dream of home ownership. With that being said, if you were in my rates show this morning, you will note that we mentioned that these first time homebuyer options are not for cash out refis. They're for purchases and for rate and term refinances. Now, what are our options, right? Let's get right into the crux of the matter. We have different home buyer programs, right? Now, I was mentioning the ones that we don't really offer that much because they're more localized in nature, right? The assistance is limited more to the county, state, or municipality, city where the property is located and where the borrower resides. And why is some of the reasons why we don't really offer those options is because first, the loan originator, as well as the organization, us, would need to be approved to offer those programs. Then those programs put restrictions in the comp plans and in other methods of operating that then we would have to have that method of operating throughout our complete footprint. And we are a national company. We are not a local company. So we would not be able to custom tailor our operation to fit the requirements of a localized plan and then not be able to operate with the flexibility that we need to do so at the national level. So that's why we can't really offer those niche programs that you see out there. But the majority of the times, those niche programs are just exactly that, a niche program meant to serve a very small segment of the market because those programs are dependent on funding availability. When the money's there, they can close the loans. When the money's not there, you're just locked and loaded with your pre approval waiting for funding. So it's the timing, the waiting for funding, and the having the property. And it's sometimes they don't coincide. You know, you may have the property and not have the funding, or vice versa, have the funding and now be able to find the property. So again, not a lot of flexibility there working. Uh, those programs are also at least the ones that you may hear more about, you know, like the ones that give you 35% second mortgage, 35% of the balance, deferred payment, all that kind of stuff that sounds really good on paper. But those programs are really meant to help those borrowers with the lowest income, right? And that's a very small segment of the market that's really going to qualify for those. And when they do, usually there's going to be certain developments then that were made custom tailored to reach out to them and be available. Basically, new construction where they could be offering only to low income buyers due to the fact that there could have been a community reinvestment act in a community that says, yeah, we'll give you this land to build on, but you have to offer it only to low income borrowers. So, you know, again, those programs have a lot of catches to them, makes them pretty difficult to offer on a national level. Hence, we don't really offer them too often. Now, what we do get a lot more involved with, which are more national programs, are Fannie Mae's Home Ready program, which provides a 3% down payment option and can be combined with some first time home buyer benefits like hometown heroes or like some of the deferred second mortgages that are not as extensive. Freddie Mac Home Possible also offers 3% down option, can also be combined with these first time home buyer benefits. I'm going to get into these in detail now in the presentation. Don't fret. And FHA, which is not a first time home buyer. That's one of the biggest misconceptions out there, that your typical consumer, because of all the layman's jargon that goes out there, may think that an FHA program, because it does offer um, 3.5% down payment, they may consider that that is for a first time home buyer, but it's not. But why I have, and I will get into the FHA loan, is because it does offer the ability to combine it with, if you saw the presentation, the training that we had on that earlier in the year, do offer down payment assistance and closing cost assistance options that you can use without any income restrictions at all, other than the regular FHA guidelines, plus a little bit of tweaking, which I'm going to get into, regarding maximum DTIs and minimum credit scores that you can have. But the whole point here that I wanted to get into, and which I touched on this morning in our podcast, was that first time home buyers, since they are buying their first home, do not have any equity built in anything that they're rolling over, right? It's real easy when you're getting, or should I say easier, when you're getting that buyer who's selling their current home, is going to be netting 50, 60, 70, $80,000, and is going to roll that money over into their new home. So they're not going to be putting down 3%. Maybe they'll put 5, maybe they'll put 10, or maybe they'll put 20. Great deal, right? It's going to be, very competitive buyer putting offers out there. But the main thing there is that they're not going to be stressing out so much on the fact that, oh, the price is high and it's a $500,000 purchase, and I got to come up with all this money if they were to go 5 or 10%. Hence, they want to go with the low down payment options, and which Fannie Home Ready, Freddie Home Possible, and FHA provide. So let's get into some of the basics here on each program. The first one of the ones that we're going to be discussing tonight is the Fannie Mae Home Ready program, right? This is a 3% down option. The main thing to note here is that you can combine it with a community second up to 105% CLTV, combined loan to value. That's only possible with this program if you're combining it with a community second, which is a second mortgage from an eligible state, local, or municipal authority or agency, or a 501c3 nonprofit corporation, or a tax exempt religious organization, or the borrower's employer. That's really good to note there on those. Obviously, any of those community seconds, if it is combined with the Fannie Mae program, would have to run through an additional review by underwriting, which would probably take another 4 or 5 days of review by underwriting. But it's a pretty easy process. So if you know of the community second, you can combine it with the home ready option to increase the CLTV and help your borrower out with some down payment assistance or closing cost assistance, whatever you want to consider, with additional funds to help them close the transaction. Now, it's really important to note the eligible properties, because they do vary between the Fannie Mae Home Ready and the Freddie Mac Home Possible. They vary a little bit. But safe to say, the biggest thing that I like here to point out is how they will allow 2 to 4 unit properties, right? Duplex, triplex, fourplex, as we like to call them in South Florida, up to a 95% loan to value. These are all primary residence loans. That's a really big deal because a primary loan on a duplex, for example, is max 85% financing on a non home ready option. Triplex, fourplex, I think is going to be like 80% or something like that. I haven't looked at it, but I know that it's definitely not 5% only. Your double wide manufactured home is 97%, and they run that through the manufactured home advantage to give you some pretty amazing rates. No single wides, only double wides. So you got to be careful with that. And then warrantable condos at a 97% LTV, which is also amazing. But you got to understand what is a warrantable condo. Is a condo that abides with Fannie Mae's requirements for a condo, and you got to run through the list. It's going to be dealing with topics like litigation, percentage of residences occupied by primary residents and second homes, and then those occupied by tenants, um, percentage of residences that are 60 days or more delinquent in the collection of the monthly association fee. And probably the biggest one, at least in Florida, is if the association is collecting at least 10% of the annual budget into a separate reserve account. And one other one that can get you in trouble in some areas is, does one entity own, a large percentage of the units other than the developer, right? So those are some of the pinch points when we're talking about condos. And you can also do modular homes in the Fannie Mae option, right? Now, a modular home is not a manufactured home. A modular home, for all intents and purposes, looks like a site built home, which could be either concrete block and stucco, or frame and stucco, or frame and siding. Those would be site built homes, what you would expect a traditional home to look like. Modular homes will look like that, except they are prefabricated. You could have like the plumbing and the electrical and certain wall panels, and then they come to the site, put all the panels together, and when they're done, it looks like a site built home, but it's a modular home, right? So keep an eye on that. And that is not a mobile home either. And a mobile home is not a manufactured home either. Like as we've discussed in our manufactured home training, big misconception. The phrase is used too much to refer to both. People are too used to using the phrase mobile home with, because it looks sort of like a trailer, right? But it's not. A mobile home does not have land associated with it. You may own the actual unit, but you don't own the land that it sits on. It's usually in some type of a mobile home park, like the phrase suggests, right? So it's a mobile home. Well, that's not a manufactured home. Can't do those. Now, I'm going to bring up some of the nice points to consider here when you are going over these deals. If you have a non-occupant co-borrower, which is allowed, the maximum LTV is going to be 95%. So not every co-borrower has to be listed as occupying the property, right? Sometimes we get the borrower, co-borrower, and then we get mom and dad, grandma, grandpa, aunt, uncle, sister, brother. They don't live there. They live on the other side of the country. Okay, 95% max LTV on that deal. Now, one of the big benefits of these programs is how they facilitate the borrower's entry into the property, like I was mentioning earlier, regarding funds, right? Because you're usually going to need some help with the funds. So here's where the structure is important, because if you have a one unit property, the borrower is actually required to have 0% contribution from their own funds. So depending how creative you get, maybe you have that community second that's bringing in, let's say $10,000. Then maybe you got a little bit of a lender credit with the rate. As you saw this morning, I was able to get up to a 1% lender credit. A little bit higher rate, of course, but still 1% on a $500,000, $485,000 loan is $4,850. That's almost halfway to their closing costs. You could have, depending on the market that you're in, some seller contribution, or you can have, as I sometimes negotiate with my realtor partners, when I give them that pre-approved buyer, you could have some realtor credit also involved. So there's a lot of different ways to get some money to help the borrower close the transaction. Obviously, it's really easy to put it in theory, but in practice, it's a different story, especially with the seller contribution. But the point to note here is that is technically 0% contribution from the borrower's personal funds if it's a 1-unit property in this program. 2 to 4 unit property, again, the ultimate house hack for our first-time home buyers is to buy a duplex, triplex, or fourplex as a primary residence. Be there for a couple of years and then move on. Do a cash out refi on the property in 2 or 3 years. Get your money to buy the next one. Rent it out. Positive cash flow at that point. Our rates will probably be 4.5%. You'll have 20-30%, hopefully equity appreciation there. Cash it out, have a lower payment than you're at right now, get $50,000-$60,000 and buy another one, right? That's the house hack. But perfect opportunity. But in this case, you are required a minimum 3% contribution from the borrower's personal funds, which is fine because that's your 3% down payment, right? Something else to note here on these is that the income, this is the income limitation portion of it, but there is a workaround to this. The income is limited to 80% of the area median income, unless the property is in a low to moderate income census tract. So, here I put in the presentation here, there is a lookup tool, but it's pretty easy to find. You just go you just search in your search engine, Fannie Mae geocoder or Fannie Mae AMI lookup tool. It'll take you right to it. And all you need to do, put in the complete property address with the zip code is going to pop up the census tract where the property is in, is going to let you know if it's what the HUD median income is. And then you can also look in the census tract to see if it's a low to moderate income census tract, which if it is, then the income limitation is removed. Now, gifts, grants, community seconds, and up to 3% interest party contribution for LTVs of 90 to 97% are different sources of funds for the transaction. So I did mention realtor credit, seller credit, all of that would fall in that 3% interested party contribution limit. Then we talked about the community second, which you can take it up to 105%, and then gifts and grants as well. Now, the program does have reduced mortgage insurance. If you recall this morning's show, the mortgage insurance factor at a 97% on a regular first-time home buyer program, which I'm not highlighting on here because it's just basically you got to be a first-time home buyer and it's 3% down. That's it. No other benefit other than that. But on a regular 3% down option, it's 0.35% is the MI factor. Whereas on this program, it's 0.25%. So the difference there in this morning's quote was about $35 more or less between one and the other. So that's fine just for MI. That's a good chunk of change. And home buyer education is required. However, both, if you have multiple borrowers, all of them don't have to do the education. Just one of the borrowers has to do the education. So this is Fannie Mae's home ready option. Then we have Freddie Mac's home possible option. So I want to touch base here a minute on why you would consider one option over the other. It's not usually going to be about the rate, right? Because the rates are very similar. You may get like a 0.125% difference in rate between one and the other, which is not a whole lot of a difference. But the main reason you're going to use one over the other, A, is going to be if you have a self-employed borrower. That's probably the biggest one. Why is that? Well, first of all, with Freddie Mac, if your borrower has been in business self-employed for at least 5 years, you're going to automatically get the 1 year finding for business tax returns. That's a big issue, because what if your borrower had not so good of a 2021, but had an amazing 2022, right? And if you were to use the 2 years, you may have, let's say, $50,000 in income. But if you were going to use the 1 year, maybe the income was 100 grand in 2022, then you could use 100 grand. So, my definitely look at that if your borrower is 5 years or more in business. Freddie Mac and other self-employed borrower reason, you see the trend here now, self-employed borrower, think Freddie Mac, is the way that the self-employed income is calculated. And if you have $100,000 ordinary income on that self-employed borrower's K1, assuming he has an S corp, right? And lines 1, 2, or 3, I think, on the K1 show ordinary income of $100,000. But line 16D in that Schedule K1 says $20,000 in distributions, right? $100,000 ordinary income, $20,000 in distribution. If you went Fannie Mae with that borrower, the income is $20,000, right? Mind blower, right? They're claiming 100 grand. They're going to pay tax on 100 grand, but we say nope. Fannie says you didn't distribute 100 grand into your pocket. You only distributed 20. So your income is 20. Freddie Mac gives you a workaround. Freddie Mac says, we will let you use the $100,000 in income as your base. Obviously, you got to work the income calculator, but we'll let you use $100,000 if the business has liquidity. So you do the separate liquidity test, which is also available as a worksheet. Pretty basic though, assets minus liabilities. As long as you have a positive number greater than zero, the business has liquidity, you can use the ordinary income for your calculations. Big difference, right? That's probably the biggest one. And another reason why you would use Freddie over Fannie, and it's pretty big nowadays, is how they calculate the payment on a deferred student loan. Because just because the student loan is deferred and doesn't show a payment in the credit report doesn't mean we leave it at blank or at zero. That's not the way it works. You have to fill in a number according to the guidelines. Fannie Mae says use 1%. So $100,000, which is not it's a pretty typical figure. These students nowadays, $100,000 student loans, that's $1,000 a month that you're going to have to add to the liabilities, right? Whereas Freddie Mac says 0.5%, same as FHA. So now that's $500 versus $1,000. That's a $500 swing. That's 100% difference. $500 is a lot and can make or break your DTI. So again, that's why you would be considering Freddie over Fannie. Now, another reason, less common, would be you're in the DU and Fannie didn't approve it, but Freddie did, or vice versa. So I've seen that happen because the algorithms are different in how they assess the risk. So you may get those cases where one of the agencies approves it and the other one doesn't. So keep that in mind as well. So now that we've stated the main points, so you would go one or the other. There's some other minor points. As you will see from the bullet points there, the LTVs are the same, and especially how they treat allowing community seconds, right? The eligible properties are going to be pretty much the same. Uh, what I did notice, I didn't didn't write it in there, was Freddie Mac actually. For those of you out there in those types of places, Freddie Mac does allow log homes. So you got to have at least two log home comparables. So those of you that live, with Paul Bunyan and all that, log homes, think Freddie Mac, another reason to go to Freddie Mac. They do have their own geocoder for the AMI, so you would look that up as well. It's going to be the same numbers pretty much, Fannie and Freddie on the area median income. They just have different links to go to. They're going to treat gifts, grants, and interested party contributions the same. One unit property is going to be the same, 0% contribution from borrowers' personal funds. 2 to 4 unit properties the same. They allow the 2 to 4 unit properties also to go up to 95%. Oh, one thing I did want to mention though, is how they treat manufactured homes. I think that there's an issue with Freddie Mac and manufactured homes. Even though they'll let you use log homes, I believe they had an issue with manufactured homes, which is why I don't have it there on the list. Again, reduced MI, the same reduced MI factors as Fannie Mae, Freddie have the same exact amount. And again, home buyer education required when borrower is a first-time home buyer. Now, they're very similar in their credit and income requirements. So I wanted to touch base on a few of those points right here. Minimum credit score, as you know, for any conventional loan is 620. Just because these are first-time home buyer loans does not mean that that requirement is eliminated. However, remember, that's a 620 in theory. That's a guideline 620. But it's going to, in the end, going to be determined by LP if you're going Freddie Mac, or DU if you're going Fannie Mae. The algorithm determines that. And then on top of that, the cost of the MI, right? Because as you go lower in the credit score, the MI factor increase. So even though it is reduced MI, it's going to really get really high up there. If you got a 620 borrower, instead of being $109 like I had in the quote earlier this morning with my 800 credit score borrower, it's probably going to be closer to $350 or maybe even more if you're at 620. And remember, MI has to approve it. So there may be issues with that 620. Just because you got an automated underwriting approval doesn't mean MI is going to accept it. They got to review it, and there may be things that they may not like. So keep in mind, when you got those lower credit scores at that point, it may be FHA instead, right? Usually, because FHA, the mortgage insurance, is based on the LTV. It's just a set factor, and the MI factor was reduced. Is based on the LTV and not the credit score, which is why we tend to structure the lower credit score loans more to FHA than conventional, right? Even though, and I was talking about DU or LP accepting, the maximum DTI theoretically again is 50%, right? 50. However, again, this is automated underwriting. This is not manual underwriting. So in the end, the risk profile of the loan, the big picture, is what's going to determine thumbs up or thumbs down on your deal. So you can't just pre-approve the deal or, let's say pre-qualify the deal without running automated underwriting just because it was a 620 credit score and a 49.8% DTI, and you're too lazy to take the complete app, review the documents, and give the customer what they really need to go shopping. A solid pre-approval based on an automated underwriting pre-approved accept if it's LP, or approve eligible if it's DU. That's how we do it at the Mortgage Calculator on all of our agency loans. We pre-approve the borrower complete application, and now we have a locked and loaded borrower. As soon as they find a property, all we got to do is plug in the address, update the pay stubs if it's been more than 30 days, update the bank statement if it's been more than 30 days, and disclose the file. But if they're quick, if their realtor's quick to find them a property, you pre-approve them now, and in a week they come to you with the contract, that's it. Pop in the address, put in the estimated value, disclose the file, ready to go. And that's why our realtor partners also love working with us, because we are very thorough. We are consultants. We're not, pushy salespeople just who don't care about the end result. Because what happens if you just pre-qualify this borrower, and then when you go to run that automated underwriting, all of a sudden you can't get an approval at a 97 or at a 95, and your borrower doesn't have any extra money? What do you do now? Now, they're under contract, and now you got to be looking at, ways to cancel the deal. So again, really important to pre-approve the borrower properly on the agency loans. Now, real important here to note is how these programs differ a little bit from traditional, conventional, is in how they treat bankruptcy, foreclosures, short sales, and deed in lieu. It's basically whatever automated underwriting says. If the system gives you the approve eligible or the accept, you're good to go, right? So don't look at the regular seasoning requirements and say, oh no, it got to be 4 years. Oh no, it got to be 7 years could get a foreclosure. 4 years could get a bankruptcy, whatever it is. No, just run it. More reason to run it through automated underwriting, folks. Don't be lazy, because you could be missing out on deals. Now, judgments, garnishes, and liens must be paid off at or prior to closing, right? There is no ifs, ands, or buts on that. So that's why I always tell the MLOs when we're talking about in this topic in training, know the credit report, right? Don't just look at the FICO score and say you're good to go. No. You got to go deep into the credit report. Look at how they handle the account. Look for disputed accounts. Look for judgments. Look for collections. Look for charge-offs. Look for all these items to see how the system tells you to handle it. Which, mentioning charge-offs, if it's past due collection or charge-offs, AUS is going to tell you what to do. Either we took these into consideration, you don't have to pay them off, or hey, this accounts need to be paid off. But then it's very important that when you are setting up your file, make sure that the accounts are properly coded as what they are. Because sometimes when the credit reports are pulled into the LOS, it may inadvertently get the label on the account switched from to revolving or to installment, which is what they originally were, versus collection and charge-off. So make sure you have that properly labeled before you run your automated underwriting. And now here's another really important point, because again, this is high LTV and they're making a lot of exceptions in how they normally handle their business. But then they're going to look at that housing payment history. We're talking about mortgage payment if they own a property previously, or rental payment history. So if they're showing excessive delinquencies of 60 days or greater late in the past 12 months, they're not going to be eligible. So that's not going to show up in your automated underwriting, but that's something where you're going to have to ask your borrower, hey, you're renting, have you been late? You got to ask them, have you been late? You're going to have to ask them also, because you're going to have to provide a payment history. If they're paying to a management company or a real estate office, they will accept what they call a professionally prepared verification of rent. If they're paying to a private individual, they're not going to accept a privately prepared verification of rent. So they're going to have to provide a payment history, right? Canceled checks for the past 12 months, or debits from their checking account for the past 12 months. So if they've been paying cash or with a money order, they better have been debiting the money from their checking or savings account equal to the same amount. Because if they're just grabbing up cash and they got saved up and paying the landlord cash because the landlord likes cash, well, you're not going to be able to document your rental payment history, and that's the same as being late. That's a big problem. And disputed accounts. I did mention look for your disputed accounts in the credit report. Why? Because when you run the automated underwriting, one of two things is going to happen. It's going to say, hey, we identified these disputed accounts, but you're okay. We can approve you with those disputed accounts. You're good to go. Or it's going to say you got some disputed accounts. We were not able to issue an approval based on not being able to determine what's going on with those disputed accounts. And if that's the case, then that disputed account has to be removed off the credit report, not through a supplement. The customer has to get it taken off the credit report, and then you have to do a rapid rescore to get the information updated as soon as possible so you can try to close. A simple credit supplement is not going to satisfy that because the new credit has to show in automated underwriting. The only way that's going to happen is to get the disputed information removed and get it updated at the bureau level through a rapid rescore, not at the local level, which is what a credit supplement does. So now we're going to talk, last but not least, about our FHA options for first-time home buyers that can be combined with down payment assistance. So this is a little bit of refresher on the DPA program that we did a few weeks ago, right? Now, what's very important to consider here is you do not have to be a first-time home buyer to get an FHA loan. You just have to be a primary home buyer. Just like the first-time home buyer conventional options require you to be a primary home buyer, this one just requires you to have this be your primary home. Cannot be a second home, cannot be investment, right? It has to be your primary. And then there is no income restrictions on the down payment assistance portion, but there is some tweaking that does occur to the DTI. So, and some tweaking to the credit score because FHA as on its own does not have a minimum credit score requirement. The minimum credit score requirements are placed by the lenders or investors that offer FHA as overlays. So the guidelines are the same, but each investor or lender decides the type of loans they want to originate, which is going to determine the loans that they put into the packages that they're going to sell to the secondary market. So depending who's buying their loans or what they feel comfortable selling is the overlays that they put. Some go to 520, 500, others 550, others 580, and so forth. So when you're combining with DPA, they add overlays. The overlays are minimum credit score of 620 to use the forgivable DPA option and minimum credit score of 660 to use the repayable DPA option. And in both cases, the maximum DTI is 50%, 50, with an automated underwriting approval. You know that FHA, I think, goes to 56.9, somewhere around there, if I'm not mistaken. Well, obviously with DPA, they tighten it up a little bit to 50%. No need to be a first-time home buyer, like I mentioned. No area median income restrictions either. You can be making $180,000 a year. God bless you. You can get it. You can get the DPA as well, right? That's a beautiful thing. Now, they do restrict the property type. So if you're going to combine the FHA with DPA, if you don't combine it with DPA, you can do 1 to 4 units up to a 96.5%. You can also do manufactured homes up to a 96.5%. If you're using DPA, it's 1 to 2 units only. The two, and they do manufactured homes, but on the the duplex, which is a 2-unit, and the manufactured home, there are loan level price adjustments. It is more expensive. They'll still do the LTV, but they charge you more for it. So when you do combine this with the forgivable or repayable second mortgage, it is equal to 3.5% of the sales price. That's the amount of the assistance that you're going to get. The forgivable option is, like it states, it's forgivable. It's a deferred payment, right? Which means no payment is made. They put the total amount as a lien on the property. And after 5 years, if you're current on the loan and you still live there as your primary residence, it is forgiven. The repayable option is, I think, is 9.9% interest rate. It's a 30-year amortization, but it's a 10-year balloon. So if you're still there after 10 years in that loan, you got to pay it off. So that would be a good time to do a refinance and consolidate and get some cash out and a little bit lower rate, hopefully, at that time. So repayable option is 10-year balloon with a 30-year amortization, 9.99%. And then you can also combine FHA with closing cost assistance up to 6% of the sales price. That's a good amount. That would cover everything. They have a 3%, a 4%, a 5%, and a 6% of the sales price closing cost assistance. And as I mentioned, one of the benefits of this, like the other two, like the Home Ready and Home Possible, it is a national option, not restricted by any local regulations of any type. And I already mentioned those bullet points: max 50% DTI, forgivable is forgiven after 5 years, and the repayable is amortized over 30 years, but due in 10. So again, a lot of good ways to get your cash strapped first-time buyers, or even you're not first-time buyers, into a property with limited resources, especially using this last option, DPF, which we have a few good conduits that can get you up to 6% of the sales price as closing cost assistance.
All right, let's see here. Do we have any questions coming in? Let's see here. When quoting an open blows, anything else you need to get TPA quotes. All right, let's go ahead and wrap it up then here. We will be right back here tomorrow at 7 p.m. Eastern time with more on working with first-time home buyers. And we're going to be talking about structuring actual first-time home buyer loans. So, Jose, you wanted to say something?
No, yeah, that's where I'll be able to help them and show them the differences in the quotes and the pricing and how to make sure that you can get compatible pricing for your borrower.
All right, perfect. Well, thank you everybody for tuning in. Every Tuesday, Wednesday, 7 p.m. Eastern, we do these loan officer trainings. So we will see you all tomorrow, 7 p.m. Eastern, for the next episode of the loan officer training series with the mortgage calculator. Have a great night, everyone.
Thank you, everybody.
Thanks, everybody.